Okay, good morning and welcome everyone to our Tuesday morning market outlook. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And like I normally start off this Tuesday morning outlook, I just want to say again, I hope everyone is staying safe, staying at home, doing our part collectively to contain the spread of this virus. And hopefully we can get back to our normal lives sooner than later if we all do our part. And for those of us that are lucky enough to be gainfully employed during this process, I hope that we all consider being compassionate and give back to those of us that may not be as fortunate, whether it's to your local food bank or perhaps to medical professionals right now that don't have access to the right supplies and things, supplies that they need to do their job. So I hope those of you that are have the ability to consider giving back in that front. So let's go ahead and get started. The big news that we have in the market is really the fact that Federal Reserve has really stepped up on the monetary policy side. So what we've seen is a slight improvement in market liquidity, and I'll show you some of the evidence of that. And this might provide the floor that we currently are trying to seek in these asset declines. I get a lot of questions right now whether I think this is the market bottom. I certainly think that we are starting to see some of the signs of that. I think it's too early to call a bottom, but this might be a time that you might want to consider using some of this data to inform your decisions for trading. So across the board, the Fed has effectively committed to what we would consider unlimited QE. Primary market corporate facility, secondary market corporate facilities. This is really trying to backstop the corporate investment grade market, fixed income market, buying on the primary market, buying on the secondary market across the board so that companies don't go solvent because they can't access debt. Asset-backed security purchases, just like what we did in 2008 to backstop the asset-backed market, commercial paper funding facility to fund short-term loans for corporations, and lastly, money market mutual funds, liquidity facility to effectively backstop the fixed income market across the board. QE for the treasury markets and across the board for the investment grade and high yield corporate market. So this has provided a lot of the, I would say, stability that we started to feel over the last few days. I know Friday was the first day where I felt the markets weren't in this panic mode, even though we did sell off quite a bit into the close. Yesterday, same thing. Opened up a little higher, came back lower, but felt much more normal, despite the fact that we were down at one point roughly 3%, did rally back into the close, and right now we're opening looks like about 3 to 4 percentage points higher from where we closed yesterday. I think the reaction that we're currently seeing in the market across the board in both muni bonds and in corporate bonds is this sharp rally yesterday, and we're starting to see some more of that today. So things have certainly stabilized, but again, we've seen some of that before. So we had that quick snapshot back and then came back lower. Just because we've had this quick snap does not mean that we can't move lower, but certainly the Fed stepping in is a big move, I think, in providing some stability here in the markets. So we're going to look at a few different asset classes later to show you some of the charts on this front, what we're seeing. But I will say that, for couple of weeks now, I've been talking about some pretty nasty trends. And today, we first of all, we started tracking our own COVID-19 data as opposed to relying on Bank of America research because we wanted some better data to look at for you guys. So this is the first, I would say, positive thing that I've seen over the last few weeks, which is Italy has had two consecutive days of declines in new cases. Now, we have seen a period of time where it was stable and moved sideways, but it ended up moving higher. But this is the first time we've seen 2 consecutive declining days, which is a good sign. So one of the things I wanted to show you is, so this is the Chinese data. And what we're really looking for is a chart that looks like this. So, every single chart so far, US, Italy, across the globe, looks something like this, where it looks like the start of a parabolic curve. And what we're looking for at some point, this parabolic curve starts to taper off, or what we call an S curve or a logistic curve. And what we're really trying to seek is, where is that turning point? And that turning point is usually, we can figure that out from the first derivative, or the slope of that curve. So what we did is we basically took a look at the Italian data, and this is the number of total cases. In the second column, we have total of new cases, and that's what I've plotted here. And what we've historically seen is an increase in new cases. It grows at a pretty consistent exponential growth. And then what we see out of China is something that looks like this. So this is a chart that many of you that have joined us over the last few weeks, you've probably seen. And using this type of chart, what we can really get a better sense for is the economic impact. So we look at, at what point did it cross a certain amount, at what point does it cross below a certain amount, and then we could try to measure the economic impact of that country. So what we have here is that we know that on March 8th is really when the Italian countryside starting locking things down. On March 9th is when they kind of locked down the whole country. So we can kind of get a sense that from the lockdown to peak was roughly 14 days. So that's the data that we currently have. Europe is about a week ahead of us. So when we look at the US data, what we have here is, I had the data up until, I started this on March 22nd. And what I have here again is, in orange, when we started to lock down regional areas. Started with California, then New York. Now we have a bunch of states across the board that have, effectively instituted lockdown procedures. I would say today was really the first day where I saw that the majority of this country has started to put down lockdown procedures. So what we can do is we can go from that date out roughly 14 days or so. Let's say we follow the Italian data. We're looking at roughly about April 5th to maybe find that turning point, which comes out to be roughly 1.9 million cases. Certainly a fairly large number, certainly much larger than any of the numbers that we're currently looking at. But this gives us some idea as far as the magnitude and the size of the impact. And what we started doing is, on the day that I created this, which was Saturday on the 21st, I started projecting out where I think the numbers are going to look like without intervention, without lockdown. And so far, the first 2 days have been pretty spot on, 33,000, 43,000 versus my expected 32,000 to 43,000. And I expect that this will continue for the next few weeks until we start to see these numbers, the number of total cases, deviate from the projected numbers. That's when we know we've kind of hit that, I would say, turning point on the curve, right? So right now, I still expect this curve to grow exponentially and then start to taper off. So that's the data that we're currently looking at. Like I said, we're at this point maybe a couple of weeks behind Italy, but that certainly the Italian data, two days in a row. If we can get 3 days in a row of declines, then I would say that we have a trend here. And then we can use that data to start looking at US and start looking at other countries. So Spain is also starting to come up as a country with a large number of cases. So that's the data that we're currently looking at. Some of it is good to take a look at. Now, some of the data that I want to take a look at also, as far as the economic impact, really comes from, how seriously are we taking this as a country? And as you can see, over the last week, we've seen a pretty big increase in number of people who have said that they are taking this they're very concerned, and that number is now in the, I would say, high 50s or so, 55% of users. I still don't think that's quite enough, but certainly trending in the right direction. Number of people that saying they're not concerned is trending lower. So this spread, the larger the spread is, the better, I think, for our country in terms of containing this. The number of people who have said that they know someone that have lost their job in the last month has spiked up to about 42% right now. That's obviously not good for the economy, but the fact that companies are effectively laying people off is good for the containment of the virus, not good for economic impact. The number of schools have closed, have basically almost reached 100% of schools that have closed, which is good. The number of restaurant data out there has declined almost 95% right now, which again is good for the containment of the virus. Number of people taking flights have decreased about 80%. Box offices are virtually zero. San Francisco subway ridership is down about 90%. This is the type of data that we're seeing across the board. This is high frequency data that we can get access to pretty much on a daily basis. And what you see here is a significant sharp decline in activity, which falls in line with the data that we saw out of China, which again means that we can project out fairly accurately when we can contain the spread of this virus. And if we can model that out fairly accurately, then we have a much better understanding as the economic impact, which goes back to what we're trying to do is understand when is this market going to bottom, when can we start looking at recovery from an economic perspective, from the market's perspective. So far, based on the data that we currently have here today, and again, just to reiterate again what I've been saying over the last few weeks, is that this data is is up in the air and it's changing all the time. But I will say that data has stabilized a little bit over the last few days, but again, not saying much. But right now, our projections are still roughly about 12% decline in Q2 and a rebound in Q3 and Q4. Now, this still puts us negative for the year of 2020, which again is what we're currently expecting, is that 2020 will be a negative year in terms of GDP. But negative is not necessarily bad if we know when we're going to get back on our feet. So again, right now, every projection that we're trying to make is based on when will we get back on our feet, not necessarily how big the impact is, because we know the impact's going to be large. We just want to know how quickly can we get back. So that's the data that we're currently looking at on the economic front. So let's take a look at the markets right now. So we're opening up around 233, which is still below that 235 support level. 235 goes back here to this 2018 December low. That was the low that we put in. So 235 is a line in the sand that I'm keeping my eye out on. We're pretty close to that, 233.58. If we can't stay above 235, there are still two support levels below that I'm keeping my eye out here, which is the 213 level and the 220 level. So 213 refers back to this 2016 October low, which also was resistance in 2016 and 2015. And then below that, you have the psychological 200 level to the downside. So 213 and 200 are the support levels below. We're still below that 235 level. Let's see if we can crack back above 235 today. If we do crack above 235, that certainly, I think, would be a net positive for the market. VIX pulled back significantly here down to the 54 level yesterday. I expect that today we're going to ease even further here on the VIX, which would certainly be another net positive. Whenever we see volatility peak, that usually coincides with the market bottom. So we did spend quite a few days in the 60 area. The fact that we're able to pull below that and break below that and stay below that level, again, is, in my opinion, some positive signs in the market. Looking at gold, this was something that has been an interesting, I would say, proxy for the liquidity issues that we're seeing in the markets, because I don't think it's very visible, some of the liquidity issues many times. But gold, the fact that gold sold off heavily as markets sold off was the disconnect that we saw. Basically, traders that needed to satisfy margin calls elsewhere, that needed liquidity, that needed money, they were selling gold as things sold off. This is not usual. Normally when things sell off, gold trades higher. But because of the extreme liquidity constraints that we had, gold sold off during that sell-off. And this disconnect has started to come back to life. So gold is opening up around 151, 152. This certainly means that, number one, the liquidity concerns are starting to ease. But this also means that there's still demand for a safe haven, meaning there's still concerns about what's currently going on, the fact that gold is still getting bid. Same thing across treasuries, right? So treasuries are not declining, even though markets are opening about 5% higher, telling me that there's still demand for this type of safe haven. So still a lot of uncertainty in the markets going forward, and still a lot of uncertainty going forward. So this is really where we expect some gains from the market. Now, going back to liquidity. Liquidity also has started to ease a little bit here. So last week on Friday, I said the number of names that were liquid, normally in the 120, 150 names are liquid, was only about 15 on Friday. That number has now increased about 27. It's still the normal heavy hitters that you would expect, like Apple, Microsoft, Facebook, SPY, QQQ, GLD, Bank of America, JPM, those types of names are now liquid. The total number of names that I would trade, now is expanded up to about 55 names from about normally what would be about 300 names or so. So liquidity is still an issue, but we're starting to see some of that ease. So what that means is that we're still in the phase where I think it's better to position using thematic trades, using ETFs rather than picking single stocks. But I think we're starting to get to that point where we can start looking at some single name stocks that we think are going to rebound. The implied correlation index, this is something we looked at last week, where we showed you that implied correlations went from about, on average, about 30 to 40%, shot up to about almost 100%, but has pulled back. Last week when we looked on it, Friday was 70%, now it's opening at 62. I expect today we might even get closer to that 50 level or even slightly below that 50 level. Once we cross below that 50 level, that's when it again makes sense to start picking individual stocks and start trading individual stocks rather than using ETFs. So, a lot of I would say positive data coming out of the markets over the last couple of days. So we're not out of the green, we're not out of the woods yet here as far as the market goes. Again, 235 is the level that I'm keeping my eye out on. But things certainly seem to be looking a little better here today. So, where am I focusing my attention on? I'm still looking at predominantly some of the tech names as a sector that is likely going to recover faster than others. Even looking at some of the more security-based names, we've talked about Zoom very heavily here on OptionsPlay, but you can really look at a lot of different names here in the tech sector or sectors that of companies that are going to do well in this type of remote working environment, whether that's Cisco is certainly one stock that comes to mind. Citrix, which provides some technologies for remote working, similar to Zoom technologies. Netflix is also something that a lot of people are looking at because people believe that you're going to likely watch videos more when you're at home and you're stuck at home. VMware also, a company that provides technology for remote working. So this is the type of themes that I'm currently paying attention to as far as the market goes. Another thing is just simply yield. Looking for yield is when markets bottom out, is a good trade to look for. So something like SCHD, which is Schwab's dividend yield portfolio. This is something that pays about a 4.2% dividend yield, substantially higher, about 4 times higher than what treasuries are paying right now. This is where you might see some flows into. Momentum on this currently so far looks a decent, over the last week as this continues to move lower. Momentum has actually continued to move higher, showing me that there's some stability coming into this type of market. We could see potentially a snap higher here. But, again, a 4% yield or a yield is really what you might want to seek in this type of market, because I do think that when we do get rallies, what you're likely going to see is that a lot of people, I don't know if anyone looked at data, but people have been buying every time we've been selling off. And there are a lot of people trapped in positions higher. So what we're likely going to see is as markets rally, you're going to get waves of selling because people who are invested in the markets want to get out of their losing trades. So I expect to see a lot of selling as markets rally going into high, as they move higher. So I don't expect a snapback in the markets, even if this is a bottom. I don't expect markets to just snap higher. I suspect that every time we get a rally, you're going to see another wave of selling. So it's going to be more of a slow grind higher, in my opinion, that we're going to see as markets start to, recover a little here. So that's how I'm looking at the markets right now. Again, liquidity is coming back. The Fed stepping in is really good. I will say that the largest risk that we currently see here are two-pronged. Number one, fiscal policy. We have that $1.6 trillion bill that Congress and the Senate are trying to pass. How long that drags out is a concern to me. Also, the fact that right now we're looking at US, we're looking at Italy. Those are only two countries out of roughly 180 countries out of the world that are dealing with coronavirus, and arguably, we are talking about two developed countries that have somewhat access to the world markets to fight the coronavirus. There are a lot of countries that may not have the same resources that we do, that may not be able to step in from liquidity, from a fiscal policy perspective. And that's going to have some long-term ramifications on the global economy. But obviously, US is one of the largest global economies. If US, China, Germany, France, and Japan can stabilize quicker, then that certainly would be a net positive for the global economy. But there are still a lot of uncertainties that we're still tracking. We just simply don't have the resources right now to track all these countries, and from a coronavirus standpoint, but we are going to track more and more as they become more relevant. But again, liquidity easing is certainly good. That's going to cause less panic in the markets. We're less likely going to see 7% down days where we trip the market circuit breakers. So I expect to see less of that going forward. And if we do see some selling, they're probably going to be a little bit more contained in the 3 to 4% range rather than the 9, 10, 11% declines that we've seen in a single day over the last few weeks. And so that is, in essence, currently what we're looking at. So certainly some positive data, but we're going to keep you updated as things progress. So I have a few minutes here to try to answer some questions. I hope that was useful for those of you that are joining us here. If you have any questions, please type them in the chat window. I have about 8 minutes here to answer some questions before the open. So, what's really interesting, Debbie brings up a good point. The lack of widespread testing, isn't it misleading to look at the number of cases? You would think that's the case, but as you can see, our projections are pretty much spot on in terms of where these number of cases are. So I would expect that until this deviates far away, every country's had that problem. Italy's had the same problem, but it follows a very stable growth. Italy, from the day they crossed 100 to the day they started implementing, 136% average growth every single day. The US, the same number from 100 to last week was 134%. These are spot on. So whether we test or not, this virus grows at about 1.36%, 1.35% a day. And that's what I projected out into the future. So yes, lack of testing is certainly a concern, but the growth numbers across the board are pretty much the same. So I'm going to continue to use these growth curves for our projections. What do you mean they are liquid? Meaning I would trade them. That's what I mean. So right now I'm focusing really on the top 20 names or so as far as trading goes. But again, as liquidity eases, I'll keep you guys updated. Normally we see about 300 names that are liquid. Right now, only about 50. As that list grows, I'll keep you guys updated. Does it make sense to seek yield through cover calls or cash secured puts? Generally speaking, in this market environment, cash secured puts, in my opinion, make a little bit more sense. Cover calls will limit your upside. Most stocks that you own, you're probably perhaps underwater on. And if you sell a call and the market snaps back higher, you might get called away and take on a loss. So that's my concern about selling cover calls. But if you sell calls that are far enough out, then I certainly think it's something you can do. Is it too late to buy gold? I certainly think that you've missed out on a lot of this rally here. You're already back up to 152. Can it go higher? Certainly, but I'm not sure that it can go significantly higher. What type of option strategies are most effective? This is something we covered on our Friday. It really tends to be more on the calendar and diagonal spreads, but as volatility comes back down further, that's going to be less of an edge. Vertical spreads tend to be, useful trades. If volatility comes back into the 40s, then I think vertical spreads, debit and credit spreads are very useful. When it's really high, you want to sell more calendars and diagonals. What's your take on probabilities of SPY breaking 200? I would say, with the Fed stepping in relatively low, that would be my guess here. So I'm going to hold off on saying any particular names again, because of the fact that I'm suggesting that what you want to do is focus more on thematic trades using ETFs. As liquidity keeps coming back in the markets, as volatility dies down a little and correlations come down a little, then we can start looking at picking some individual stocks. But I still think at this point it's better to focus on broader themes through ETFs rather than picking individual stocks. I think the data is just still too uncertain. We're just in the very, very early days of this country locking down. And we still have a lot more to go, in my opinion, at least a couple of weeks, in my opinion, to go before we start to see an improvement of cases as we've seen here in the US. And I think you're going to see regions that are going to be better than others, like maybe San Francisco is going to be a little better than others because they locked down earlier. New York still, has lockdown now, but there's still plenty of places that happen. So we might see pockets where this continues to grow somewhat out of control until they do lock down. So there's just too many uncertainties right now to pick individual stocks, in my opinion. Do you believe corporate bond funds will go lower? So the fact that the Fed has stepped in to basically backstop the corporate bond market, I would say that you can certainly see a move lower, but I think that you have seen somewhat of a floor here in corporate bonds. But again, there's so many, I would trade, if you're going to look at investment grade bonds, I would use the ETFs rather than pick individual corporate bonds. Because again, I think there's too much uncertainty there. Will you give us a list like earlier? Sure. I'll send out a list of what I would consider the liquid names at the moment. James, you're very welcome. Thank you so much. Rick, yes, I will send out the list. Yeah, so today on GLD, we did have that big move. I was going to turn this into another diagonal by selling the 152s, but right now we're opening up above 152.60. So I might you might want to hold off on that, or pick a higher strike, maybe that 159 strike. On this, I certainly think it's a little too late to sell that 152 strike since we're already now basically above 152. Zoom seems a little overpriced. Zoom always has been an overpriced stock. It trades at crazy multiples, but obviously this is driven more by momentum than anything else and a bit of hype. Sure, can you take a speculative position to buy some puts, but I'm not going to take that position myself. Do you think Qs have reached the bottom? Again, I think we're starting to see the signs of a potential bottom, but again, there's still too much uncertainty in my opinion right now to call a bottom. Examples of a thematic trade. So like I said, technology, I think technology or some of the security stocks, so for example, Hack, which is an ETF that does predominantly cybersecurity. I think that is that has a lot of stocks that probably have some interesting themes going forward. XLK, You know, technology, I think, is certainly going to recover faster than other sectors. Um, SLV, silver, I would imagine silver follows a similar theme to gold at the moment, opening up uh, at 13. Yep. So, you know, I think you're going to see some recovery in these precious metals, but I don't know how much higher, because if this is the market bottom, then I expect that gold would start to trade sideways a bit. It's back into that 150 range, so I think that 150 160 range is where gold might stay for a little bit unless things get progressively worse. So thank you so much. I hope you guys have found this useful for your trading day. You know, we're opening up a little higher, which is certainly probably a sigh of relief for a lot of portfolios. Keep your eye out on that 235 level. That's where I'm paying my attention to right now. So I hope you guys have a great day, and I'll see you guys here on Thursday. So for those of you that are joining us on Thursday, Michael Coe will be with me because Tom Sosnoff had to cancel. So we have a great session for you this Thursday. Please sign up. Please submit your questions ahead of time. We'll answer those questions first. We'll do a little market overview like we do typically on CNBC with me and Mike. We'll answer your questions, and then I'll be back here on Friday to do the same thing. Again, keep you updated on some of these numbers. Hopefully things look better going forward, and please stay safe. Have a good day.